I'm Greg Hunter. Welcome to USAWatchdog.com. I'm having a guest on I had on just a few weeks ago, and the reason why is because the economic numbers are in cartoon land, Looney Tunes. I mean, the Federal Reserve is now bragging about how they can print unlimited dollars, and not just the Fed president. The chair of the Federal Reserve, Jay Powell, is bragging unlimited. That there's no limit to the amount of money that can be printed, which is very freakish. And to talk about the cartoon world of the Federal Reserve and what it's going to mean to all of us is Michael Pento. Michael Pento, you're an economist and a money manager at Pento Portfolio Strategies. Michael, thanks for joining us today and coming back so soon on USAWatchdog.com.
As always, Greg, it is my pleasure to be with you.
You know, everybody's happy the president is opening up the country, and bravo to him. I'm not a Trump basher, but we are far from out of the woods, and the Fed knows it. That's why they're bragging about, hey, we can print, basically saying we can print all the money we want. What say you?
Okay, so I was on a few weeks ago, and I made a couple of predictions. So let's have a little accountability here. So I said that we were in a depression, and in the coming few weeks, you would see depressionary numbers released. But I also said that the stock market was going to come back much faster than the underlying economy because of what the Fed and all central banks are doing. So let's just talk about a couple of numbers. So we all should know that unfortunately, 22 million people have lost their jobs in the last 4 weeks alone. 22 million people. And the unemployment rate, according to me, is heading up towards 15 to 17%. Okay. That, my friends, is a depression. We also saw the April Philly Fed come out at 56.6 minus, okay, a negative 56.6. That is the worst ever. Empire State Manufacturing minus 78.2, the worst ever. And retail sales plunged in March 8.7%. That is the worst reading ever, the worst plunge ever. And that's March. We have even, in my opinion, will be something worse in April, because at least half of the, all of the month will be, for the most part, completely shut down, 90 to 95% of the economy. But then let's talk about now what's happening with the stock market, the psychology of markets. So the markets see the virus is dissipating because, or at least the second derivative of cases is falling because of the shelter-in-place orders. And that has led to the government saying that they can flip on the economic light switch, correct? And also, we know that the Fed is printing money like maniacs. And as a matter of fact, the last time I was on, this wasn't the case, but it's the case now. The Fed is now buying junk bonds and collateralized loan obligations, Greg. So just so people understand what a CLO, it's a pool of bonds. Think about, remember the pool of mortgages, mortgage-backed securities, okay, pools of mortgages in the Great Recession. They've now pooled leverage loans together. What are leverage loans? Leverage loans are loans made to corporations and businesses that already have a tremendous amount of outstanding debt. That's why they call them leverage loans. They pool these loans together into CLOs, okay, collateralized loan obligations, and then these CLOs are slapped with AAA ratings by some rating agencies, because they're, even though most of them are going to, or a lot of them are going to be insolvent, unfortunately, because of the recession, they get a AAA rating. When did that ever happen before? You remember when they slapped AAA ratings on mortgage-backed securities?
Yeah, we saw that. How that.
So yeah, so the government is buying trillions of dollars worth of junk bonds, CLOs, municipal bonds, treasuries, and the government is going to flip on the light switch. But guess what? There's no electricity. The lamp is unplugged, because you have to think about this. Who in their right mind, until there's a cure, that's readily available that cures people, 95% of people get cured, or there's a vaccine, who is going to fly on an airplane, which is a tube that circulates the Wuhan virus? I mean, who is going to go to a hotel? Who is going to go to a restaurant? Who is going to go to a major entertainment outlet until we have a dissipation of this virus and the number of new cases, and we have a vaccine / cure? That's when the economy is going to be open. So the government cannot flip on a light switch. It doesn't exist. So, that's where we stand right now. We have stock market had its, think of Easter week, Holy Week, 4 days, because we were close to Good Friday. The stock market had its best week, shortened week, in multiple decades. And that was the week that we saw all of these bad numbers, the millions upon millions of people becoming unemployed, and these horrific manufacturing surveys and retail sales plunging. Yet the stock market is in, at least on pace, I believe, very close to all-time highs. But then you're going to have the reality of the summer, Greg. The summer is going to come, and that's when they're going to open up, this phase one opening up of a lot of these states are going to happen in the summer. And then, God forbid, what happens if we have another resurgence of the virus, like we're seeing in Singapore, or we're seeing in China, where China had to close another city? Okay, we're seeing cases spike again in Spain. So if that happens, then we're going to have, I think, lights out. We have to shelter in place once again. And again, the yawning, trenching gap between what stocks are doing because of central banks and the underlying economy has never been greater.
Wow, and it's because the Fed is juicing the markets. The Fed, we're down to the Fed overtly bragging about they can print all the money they want. Basically, when have they ever done that? When has the Fed ever come out and said, "Wow, did you know we can print all the dollars we want? They're unlimited. They are limitless. We can do whatever we want. We'll do whatever it takes." When's the last time the Fed did that? You sent me a chart of the Fed's balance sheet, and let me just clue in, get close, because this is what it's pretty common. It got a little bigger. It's been getting bigger, but it's kind of leveled off here. And here we go. Here is what happened here's September of, and I've been harping on this. So my people that watch this. This is September, right down here. This little point right here is September of 2019, and then here's that 500 billion they put on their balance sheet in the last 3 months. So they were stacking money on their balance sheet, and then we get this boing, Wuhan.
Yeah. So here's what you really need to show in that chart. There's 3 things. First of all, you go back to the beginning of 2007, where it was 800 billion. So if you just move your fingers to the left, your left, you should be able to. So no, you go that way. There you go. Your right towards your right hand.
Yeah,
right
down here.
So 2008 was 800 billion. Then we had the Great Recession. Great Recession right there. Exactly.
Here, hold on.
Then
let me get it out there. There you go. 2008.
Then you go up until the quantitative, you reach 4.5 trillion. That's the apex, 4.5 trillion in 2015. All that right there. Then you go down and you see quantitative tightening. Remember, we're going to drain our balance sheet back to pretty much where it was, maybe 1 trillion or maybe $1.5 trillion, right? And then we ran into a buzzsaw, which is right there. Quantitative tightening ends. And you see what happens. The repo market melted down. This is August and September of 2019. And here's the key point. The Federal Reserve that promised they could drain its balance sheet and sell off its assets had to re-engage in QE, NQT, and re-engage in QE well before the Wuhan virus surfaced.
Right here.
Months and months before. And then you see right at we're talking about really March, April 2020 is when you see that hockey stick J-curve, not even a J-curve, it's just a vertical launch, an Elon Musk rocket ship all the way above $6 trillion. That M is millions of millions. Okay, so 1,000 million, $6 trillion, 6.3 to be exact. And that is never going to be, the Fed has proven, the ECB has proven, Bank of Japan has proven, all major global developed central banks have proven that once they get involved in a market, they cannot fully or even close to become fully extracted or extricated from their counterfeiting measures.
And what does that mean? What does that mean to the guy on the street? So they look at this and go, "Oh wow, that line goes straight up." What does that mean to me?
Well, that means to me, that means that why do I continue to have this sort of like universally accepted faith in fiat currencies? I just don't understand why people believe fiat currencies can still maintain their purchasing power. I believe that the zeitgeist of that notion is being eviscerated. Because if I've just proven that the Fed's balance sheet went from 800 billion to 4.5 trillion, they tried to shrink it, they couldn't do it. Now we're at 6.3 trillion, heading to $10 trillion. The increase in M2 money supply is off the charts. And you see a lot of this inflation going into the stock market right now, but I think later on in this year, you'll see, because of various iterations of helicopter money around the world, you'll see consumer price inflation start to tick up. Because you're seeing a vast increase in the broader monetary aggregates, and because supply lines have been cut, there's a limited amount of goods and services to be purchased. So you see a massive increase in money supply while the goods produced has diminished sharply. I mean, that's a recipe for inflation, because you are destroying the confidence in fiat money at a record pace.
I wanted to bring up this about demand. I mean, we were talking about the airlines and that they're getting bailed out, but like you said, people are going to, even if they had a cure. I mean, we got 22 million in the last month laid off. Even if they had a cure and everything was fine. Mm-hmm. And you've got all this massive layoffs and massive demand destruction. And I brought this up on my weekly news rapid. This is a chart of China. This is they're doing great in the early 90s, and then they had a little dip, and then we're doing great, man. They have 10, 15, 12, 9% growth, and then 2007 happened. Boing, there's that V-shaped recovery, and then they kind of waller around here in their mud, and bam, a Mexican cliff dive into the dirt.
Yeah. This is the evidence that, China is not going to be able to bail out the global economy as they did in 2008. They printed trillions upon trillions of dollars. Okay, the People's Bank of China prints money, hands it to a government-owned bank, who then is told, under penalty of death, they have to send that money out, lend it out to a state-owned enterprise. Okay, that's how you rescue the global economy. A massive fixed asset bubble was created in China. Demand for all kinds of commodities around the planet. Now you see the Chinese economy, it plunged by 6.8%. 6.8% in Q1. That's a record plunge for Chinese GDP, and they will not be able to re-stimulate the economy. And here's another thing why I think that the light switch has been unplugged from the wall, as far as this, flipping on the light switch and getting the economy back to where it was. So not only is this 22 million plus people, we'll find out another huge chunk of people, unfortunately, will be laid off next week. They're not going to all get hired back right away, because, as you said, people aren't going to be flying airplanes, not going to be going to restaurants, not going to be going to hotels, entertainment outlets. But there's been a serious blow to balance sheets. Let's talk about that. The reverse wealth effect. People just lost, a few weeks ago, they lost 30% of their retirement funds. 30%. That is fresh in their minds. Yes, we've gotten a lot of it back, not all of it. But it's fresh in their minds that 30% of their wealth was wiped out instantly, really in a matter of a few weeks. Never before have we seen the stock market plunge by 30% in a matter of weeks. Well, that's fresh in their minds. What happens when the economy reopens and we might have to shut it down again? Then you also have to ask yourself a question. A vast number of small businesses and larger corporations had to tap revolving lines of credit while they waited for the SBA loans to be lent out, this payroll protection program. which, by the way, is out of money. 350 billion was sucked up like that. These people tapped revolving lines of credit, and consumers were tapping their credit cards to stay afloat while they were waiting for checks from the government, which are going to be severely inadequate over the long run. So you have a massive increase in debt. You have a case where GDP has been severely attenuated. That means the ability for the economy, the real economy, to service this massive increase in debt has been wiped out. Think about that. So when people say the economy is going to snap back right away, it's a falsification of the truth. It's specious logic. It's impossible for the economy to flip on and off like a white light switch the way governments are pretending it can do. That's never going to happen. You have balance sheet destruction, wealth effect, and people will not return to normal until there's a cure or a vaccine.
Even if there's a cure, even if you could just get by with hydroxychloroquine and zinc and whatever, which is supposed to be really effective, and the mainstream press is, of course, poo-pooing it, but because it's a Donald Trump idea. And I mean, it's effective. It's not just, I think it's effective, and there's a few people that took it and got better. And this is some of the top epidemiologists in the world. One of them's in France, and he's got 1,000-person study. He's got, I don't know, 98% cure rate. But anyway, but even if we do have a cure, my thinking is the demand destruction. Who's going to have the money to have a $50 steak dinner? Who's going to have the money to go out and spend 30 grand on a medium price car? That's what they cost now, 28 grand. Who's gonna have the money to take a nice big vacation, stay at a Westin or a Motel 6? Who's going to have the money? I mean, you knock out.
You're talking about what I just said. So balance sheet destruction has been occurred. A wealth effect, reverse wealth effect, is in place. I mean, you just lost 22 million people just lost their job. I mean, how confident are you now going to go out? You've taken on let's see, consumers. They've taken out a tremendous amount of new debt. They just lost their job. Okay, we've wiped out all the jobs that were created since the Great Recession ended. Some of those people will be hired back, hopefully, very quickly, but not all of them will be hired back. And they have a very tenuous relationship to the job market right now. So they're going to go out and on this mass consumption boom. I'm so sick and nauseated of people coming on CNBS saying this is a consumption-driven economy and the consumer is rock solid. Well, sadly, that's not the case any longer. So you're exactly correct. This was not going to be a slingshot, a rocket ship bounce back in the economy. But I want to just mention something to you. I hope I'm wrong about that. But here's the problem. We just were talking about the Fed's balance sheet going on its way to over $10 trillion by the end of the year. What kind of faith are people going to have in the purchasing power of their currencies? I mean, let's just do a thought experiment here. I mean, if we could shut down the economy for 2 or 3 months and then partially reopen it with no consequences, if the Fed can print trillions of dollars and have no consequences, we could just just jump right back to where we were before. Then I say we should shut down the Treasury Department. We should shut down the IRS. We could have a normal economy. We should all we need is a central bank to print money, a post office to deliver the checks to your mailbox. Maybe we'll keep some like casinos and the stock market open so people can gamble their money, but it isn't really going to be gambling because if you make any losses, the government will bail you right out. I mean, why don't we just do that? And we can, why bother working? Everybody should just stay home and cash a check. That doesn't make any cognitive reasoning sense to anybody who just heard that. But that's what you're hearing from our central bank right now. Our Fed is saying, hey, V-shaped recovery. Wall Street carnival barkers, V-shaped recovery. Well, if that's the case, then everybody should just stay home. We should just monetize don't even make the charade of going through the motion of borrowing money. Let's just have a central bank, mail checks to your mailbox. You go out and consume. And by the way, there'll be a couple of people who are, stupid enough to go to work. So you'll just consume a few of those, paper towels that you could find in your local grocery store. But there won't be a lot of production because most people stay home. I mean, this is a recipe for hyperinflation. It's been tried many, many times in history, and it has never worked. Don't be fooled.
And it looks like, when you hear the Jay Powell, Neil Kashkari on 60 Minutes talk about how they can print all the money they want. Like, oh, wow. Oh, the Fed can
No
print all.
consequences. Right?
Oh, that's
No
fantastic. I'm saved.
Yeah.
But you're not saved.
So the sad part is that Republicans and Democrats are in a race to see who cares the least about the national debt and deficits. That's the truth. And capitalism, Greg, has been eviscerated. I can't blame Democrats. I can't just blame them any longer. I mean, you have everybody in D.C. is tripping over themselves, including the people in the Eccles building, the Federal Reserve, trying to create a fantasy, an artificial economy. And what they're doing, this is the damage. I mean, I was dumbfounded to hear Loretta Mester today on Bloomberg. She was being challenged by Jonathan Farrow, who's a very smart man, saying, "Hey, what are you guys doing buying junk bonds right now? Don't you think you're falsifying asset prices again? Is there any danger?" And she's saying, "No, we're doing what we can. I mean, doing it whatever it needs is necessary to keep the economy going." Well, wait a second. So we saw what happened in 2008, which was, everybody knows we had a massive credit bubble and the underlying economy couldn't support the debt. Now we're keeping CLOs and junk bonds, in business companies. We've massively increased the number of zombie companies out there issuing more and more junk bonds. Okay, the gap between the real economy and asset prices and debt and the underlying economy has never been greater. And then you're going to add something new to the mix, in my opinion. You're going to have a massive increase in insolvent debt. You've pushed bond yields further into artificially negative territory. You falsified prices in a massive way. And then you're going to add inflation to that mix. Think about the carnage that's to come. By the way, that is the real crash. I do believe, and I'm on record saying this before, and I'll say it again here, we will partially recover from this virus. Okay, we will eventually have a cure. We will eventually have a vaccine. The economy will get back to some semblance of normalcy, maybe in a few years. I don't think it'll be back to where it was, but close to it. The stock market will be at all-time record highs, racing way ahead of the economy. But you're still going to have record zombie companies, record amount of debt, public and private sector debt, through the roof, bond prices through the roof, yields into the sub-basement of history. And then on top of that volatile cocktail mystery mix, you're going to throw in inflation. Because unlike 2008, when we just bailed out banks, we are now directly sending universal basic income, helicopter money to consumers. That is the progenitor of inflation.
And your biggest problem is at some point this will also inflation will hockey stick out of control. Inflation will look like the Fed chart. It's down the road. Inflation's just going to go bam, straight up is what you're talking about. And people's paychecks won't go up with the inflation.
Well, the money supply growth was booming in the Great Recession of 2008, but that money supply stayed and circulated around Wall Street for the most part. We're not doing that anymore. We are now directly bailing out consumers, which, by the way, I can make an argument that you should be bailing out consumers before you bail out junk bonds. But we're doing both now. We're bailing out Wall Street in a big way, okay? And BlackRock is doing the trading. They're getting insider information ahead of time, saying, "Oh, Mr. Federal Reserve, you're going to be buying what? You're going to be buying how many junk bonds and what variety? Oh, great! I'll just front run you. I'll be a go long buyer." So you're not just reinflating Wall Street this time. They're actually sending checks to consumers, and I think that's going to be a practice that is, now that you jumped the shark there, I think that's going to be a practice that continues many, many times. There'll be many iterations of these checks being sent to people. And by the way, again, I'm not a cold-hearted person. I'm a God-fearing individual. We should be giving people enhanced unemployment. But tell me the logic, Greg. You've paid so far $350 billion to businesses so they won't fire employees. Great, that's wonderful. But then these same employees are now going to get or are in the process of receiving, $1,000, $1,200 per person plus $600 for a child. Why are we doing that? What? And even more to the point, what in God's name are we doing buying leverage loans, AAA rated, falsely leveraged loans, putting them on the Fed's balance sheet, by the way, which is now backed by the Treasury? So we're putting taxpayers on the hook for the ability for Wall Street to get bailed out in the most riskiest kind of crap that has ever been created, a collateralized loan obligation and junk bonds.
What do they see? I mean, they must be seeing in their private meetings, which don't have any minutes. What do you think they're seeing? That the whole thing could just implode, and we'd have to start over, and we'd have anarchy and blood in the streets and Mad Max. And what do they see to do this kind of? What they're doing is off the chart crazy. If I told you they were going to do this 5 years ago, you go, oh, a year ago. If I told you they were going to do this, you go, oh, come on. But what do they see? What kind of a picture do they see happening if they didn't do this?
Well, they're trying to, like all governments do, they're trying to preserve their power because they realize that, in, let's just say, at the nadir of the stock market, when we were down about 30%, the 3 years, almost 4 years of wealth was wiped out. So you think about the pension plans, both public and private, they have to make 8% per annum. And they've done so by going way out on the risk curve, buying junk bonds and stocks. Because you can't meet your pension obligations, which are underfunded by $4 trillion anyway on the public side. You couldn't meet your pension obligations by buying bonds yielding 1%. So you had to go way out on the risk curve. And now 3.5 years of gains have been wiped out, yet you have to make 8% per annum. So there wouldn't be a solvent pension program in America, or for that matter, in the world practically, if the central banks didn't panic and try to monetize all this debt. And that's what they're doing, Greg. I know we said here as a country we would never monetize trillions of dollars worth of debt like they did in Zimbabwe or Hungary, Weimar Germany, any of the great inflations. We would never do it. It's exactly what we've done. You showed the balance sheet. When you went to 4.5 trillion and you pretended that you could come back down to a more normal level, that didn't work. Repo market blew up summer of 2018. And that was before the Wuhan virus. So now we're at 6.3 trillion on our way to $10 trillion, never to be unwound. Massive increase in the money supply. I think a pretty significant increase in the macroeconomic condition of stagflation. That's where we're headed. And that's where the rubber is really going to meet the road here as far as people's lack of faith in governments, because you're going to lose faith in fiat currencies. Yes, we all know that's happening. Look at the price of gold in other currencies is at all-time record highs. And even in dollar terms, we're up to $1,700 an ounce, on our way to record highs, in my opinion. But you think about it, what is the government going to do? What is the central bank going to do when you have an insolvency and inflationary implosion of the bond market? I'm the only one I've heard talking about this, but it's so crucial because the real crash is coming. It is not going to be, and I mentioned this a few weeks ago, it bears repeating for anybody who hasn't heard it yet. A government cannot issue more debt to bail out an insolvent condition. Okay? Prima facie, fact. A government can't print more money to placate or mollify a market that is afraid of inflation. Fact. But that's what they're going to be faced with. Yield spiking because of inflation and insolvency concerns, and then there's nothing a government can do. And that's going to be not just the United States, it's going to be the case globally.
When is that going to happen?
Whenever we see stagflation and inflation approach double digits, which I think is going to a salient probability in 2021. Not early 2021, but probably, and by the way, I say these things and I'm not wedded to them. Like, I'm not a philosophical investor. I manage money here, as most people know. I don't have this dogmatic view of what's going to happen and we're going to invest that way until I'm right. I think that's, a lazy and slovenly way of investing, not very bright. What you need to do is model the economy. If my theory is correct and it starts to bear out, when do you act on it? You want to act on what you want to invest for what's happening now and what's going to be happening in the next few months, not what's maybe possibly going to happen a year from now. But here's the model. Here's how I see it right now. I think 2021, there could be a salient risk of inflation running far above the central bank's asinine 2% inflation targets. What far above it? It's already there, but even the way they measure it, because consumer price inflation could tick up, not immediately, because right now we see oil down. Oil had a $17 a barrel handle. So the salient issue right now is deflation still. But wait until these iterations of helicopter money and UBI really start to percolate around the economy. And then you might see a slingshot with inflation and a slingshot effect in interest rates. And by the way, the 10-year note now is down almost 0.5%. The U.S. 10-year Treasury, 0.65%, to be exactly accurate, of this morning. 0.65%. This is a record low. This is, it used to be 1.3% we had in the summer of 2016. Now we're at half of 1%. So think about what happens. If you have inflation meeting the fact that we have a $4 trillion annual deficit, 20% of GDP, who's going to buy all this debt? I mean, how is the Fed ever going to stop and hand the economy back to the market? Impossible. They tried that already. They tried to hand, this is my point, they tried to hand the economy back to the free market during quantitative tightening, and they couldn't do it. And that's when the balance sheet was $4.5 trillion. Now when the balance sheet is $10 trillion, is that going to be a good time to let markets function? When the market has come back with massive issuance of junk bonds that have no ability of ever being repaid in real terms and in nominal terms, and the Fed owns most of them, is that a time to back away? So you're going to have massive increases in the deflationary and inflationary cycles are going to be, they're like birth pangs. They're going to come more frequently and with much greater intensity. And that's why if you're a passively managed investor, you're dead. You have to, this is what I do. This is why I created the inflation, deflation, economic cycle model. I want to invest on the right side of these deflations and inflations. Because there are times you're going to want to overweight bonds like you are now, but there are going to be times when you want to short bonds. That's coming.
Do you think we'll get a tsunami of inflation? Could that just sneak up on us and all of a sudden, bam, within a few months, we could get hit with a tsunami of inflation? Everybody thinks, oh, this is great. I got a check, UBI. Oh, look how much beach we have here. Look at the water going out. It's beautiful. Wow, I don't have to work. And then all of a sudden, we get the, right?
Well, here's the danger. You're paying people more to be completely detached from the workforce. They're making more because of the checks, because of the enhanced unemployment. It's more beneficial for you to become detached from the workforce. That's the real danger. You become detached from the workforce, you stop producing goods and services, yet you're continuing to get unemployment and universal basic income and helicopter money from the government. The money has to go somewhere. And where does it go? It goes into the evisceration of confidence in the purchasing power of fiat currencies. That's where we're headed. And yes, there is a risk that we blow right through their phony 2% minimum inflation target, and they don't care. They really don't care until it gets to be high single digits, the way they measure it. You imagine what would occur? So you have junk bond yields. Let's just have a thought experiment. Junk bond yields, record lows. Well, let's just take it to Japan. You have negative yielding 10-year Japanese government bonds. You finally get that inflation because Japan's doing it too. Helicopter money. Europe's doing the same thing. Helicopter money. You finally get people saying, hey, I'm not working. I'm not producing. I'm collecting my income. Give me my helicopter money. And then you get a J-stick curve effect in inflation. Boy, oh boy, you're going to have a government like, what do we do now? Do we keep printing money? Do we rapidly increase the amount of money that we're printing to try to hold down all of these yields that are spiking?
The whole world.
And the
we'll
whole
go
world.
Weimar.
The whole world goes Roman Empire. In the peak of the apex of Roman inflation, 1,000% per annum. The whole world goes, because we're all doing it, so you won't have a Weimar collapse where you have one currency collapsing against somebody else's currency. That's not going to happen. Your whole world will go intractable inflation. But it doesn't even have to go Roman. Just double digit inflation meets negative yielding rates. Negative yielding junk bonds meet double digit inflation and insolvency. Wow. That's where we're headed. Think about it.
The money's no good and the bonds are no good.
Well said. That's perfect. Exactly. Unfortunately, we had $23.5 trillion in debt coming into this crisis. So you added the annual deficit, $1 trillion was already baked in the cake. Then you have $2 trillion in stimulus, 2.3, and you're over 3 trillion. And then you have the automatic stabilizers that kick in. That's another trillion or more. Who's going to buy $4 trillion of an annual deficit? Who? It's 20% of GDP. Think about it. Who's going to buy all that? And is the Fed continue to buy all that debt and they're sending helicopter money? And people are going to say, oh, gee, I'm going to still go to work and produce something and think my money has value? No. It doesn't work that way. Like I said, we could just all stay home, wait for the postman to deliver our check. If this doesn't have any consequences, the truth is that has never worked. There are massive consequences to what they're doing. Newton's third law of motion, like I like to say, for every action, there's an equal and opposite reaction. Think about $10 trillion of a Fed's balance sheet. We already have globally $8 trillion worth of global stimulus. Almost all of it, in fact, all of it and then some, has been monetized. I learned today that the Fed is buying twice the amount of all bonds that are issued. What could possibly go wrong with that?
Inflation. For little people who don't have a lot of money, should they buy silver? Should they pay their car off? What should little people do?
Well, I recently, since the last time I was on, was about 3 weeks ago, I doubled the increase to precious metals. Oh. I did include a couple of gold mining shares in that mix too. So I have 1/5 of the portfolio right now in gold and gold-related shares.
Wow.
Of course, you'll have a little bit of pullback as we enter into this light switch illusion, as I like to say. But when that illusion is shattered by the fact that consumers' behaviors don't really change until there's a vaccine/cure, then you're going to see these earnings reports continue. I mean, the amount of destruction of the real economy and earnings destruction is unprecedented. This is a verified depression, and you just can't paper over that by printing money. There are massive consequences coming, and we're going to see, I believe, stagflation like we've never seen before in 2021. That's my base case scenario. Could be wrong, if the government stops sending checks, they completely stop with helicopter money, they stop printing money like mad, then you have to ask yourself the question, when you have a $4 trillion annual deficit, 20% of GDP, who's going to buy it? And who's going to buy it at 0.5%? That's the problem. Central banks have created this massive trap for which there is no escape, in my opinion.
Except hard assets and owning your stuff.
Yeah, you've got to own. So farmland is something I really espouse owning. Precious metals, I espouse owning. and active management. So you can give yourself the ability to short the market when it's appropriate.
And you don't think the market's going to go any lower from here?
I think we're in a W phase until we start getting a lot of the country open.
Oh, you think it's going to go up and then bam?
Yeah, up and down, up and down, up and down, up and down until the economy opens fully the way the government wants it to. But then you get a real disappointment, a real shock as to how many people actually return to work and how many people are semi-permanently detached from the workforce. Multiple millions of people are permanently or semi-permanently detached from the workforce. That's going to be the real shock. And the earnings of S&P 500 companies do not come roaring back. That's the real shock. And that's when I think you could actually test the lows again in the fall. That's the base case scenario. But again, this is not the real crash. The real crash is coming, and you still have time to prepare for that. Because that's when, Greg, this is what I really truly feel. So if you go back to 1989 in Japan, they had this massive blow up off top. And 30 years later, they're still down over 50%. And this is a country, Japan, that has no problem with monetizing debt and helicopter money. No problem with it whatsoever. And they're increasing that that level of intervention, and they still can't get their stock market back to where it was. China, command and control communist autocracy. 2007, that was their epic blow-off peak. They're still down 50% from that level, okay? So I think the United States, unfortunately, is going to have something very similar, where we experience our massive blow-off top sometime 2020, if it didn't already occur, and then we just plunge all the way down in that real crash that is coming.
Michael Pento, thanks.
I just want to say one more thing. My prediction is the possibility of 50 to 80% plunge in asset prices in nominal terms, not in real terms, not in inflation-adjusted terms. That's the real crash, and that's not being hyperbolic.
Wow. 50 to 80% in nominal terms. Wow.
Yes.
Michael Pento, Pento Portfolio Strategies. You have pentoport.com. You also have I think you have a blog, a midweek reality check that you pay $50 a year for. So I don't know, $1 a week to get your read on what's going on, which I think is fantastic. I'll put those links up, correct? I get that right?
Yes, absolutely. Midweek reality check. You can have a 4-week free trial, and then it's $49.99 for a year of that, assessment of the economy and real data that you won't find on CNBS. You only find here at outlets like USA Watchdog. And then if you want to become a client, if you have around $100,000 to invest, you can reach out to me or the office here. My email is mpento@pentoport.com. The office number is 732-772-9500. And the website is pentoport.com.
Michael Pento, money manager and economist. Michael Pento, thanks for giving us the cold bucket of water in the face about what's coming down the road. Not a V-shaped recovery, a recovery, but not what people are talking about. You should adjust your thinking accordingly. Michael Pento, thank you for joining us today on USAWatchdog.com.
Thank you for having me, Greg.